Hello, everybody. Welcome back to another episode of the Investor Motivation Podcast. My name is Amy Lehman, and we are joined virtually today by Rob in Melbourne. Hey, Rob.
G'day there, Amy. How you going?
I'm good, thank you. How are you?
Good, thank you. I'm a little bit excited, to be honest. I've got a big couple of nights ahead of me. I'm
Yep.
off too. Can you
I
see that okay?
Yeah, for those that aren't watching the podcast on YouTube, Rob is fully dressed out in his Iron Maiden shirt.
You need an Iron Maiden t-shirt if you're going to go to Iron Maiden. So seeing them tonight, Friday the
How many
6th.
how
And,
many Iron Maiden shows are you going to?
well, I'm going to go to four all up. So two in Melbourne. I'm taking the kids tonight, and then tomorrow night I'm going with a schoolmate. Then next week I'm going to head up to Sydney and see them twice up there.
Yeah,
Because when your favourite band comes to town and they're probably just a little bit older than what they used to be, I'm going to take my chances. And
yeah,
I
absolutely.
suppose I spend all my time talking to my clients around making sure that they, obviously, make the memories to reduce the regret down the track. So that's part of the theory. And I've
Yeah.
got the flexibility to go and do a bit more stuff, so I'm going to do it.
Why not? Have you got a different top for every night, or is it a wash and repeat, or a turn inside out, turn back to front?
Yeah, it'll be inside out, back to front. It'll be merely the stubborn understains holding my tops together by night four.
Beautiful. I'm
that's an
glad I
old
asked.
that's an old young one's quote. But yeah, I've got a few backup Foo Fighters tops that I can wear as well if need be. But it shouldn't come to that.
Yeah, no, that
Yeah.
sounds lovely.
What are we chatting about today, Amos?
Well, today we are going to be covering off on, I guess, paying down debt in one respect. Well, the option of either paying down debt for pre-retirees and what age we probably consider whether it is a priority to pay debt or salary sacrifice into super and build that retirement nest egg.
Yep. And in addition to that, we'll be covering off on some of the property, I suppose, the two options that people have got to save tax in Australia. And it seems to me, whether it's my algorithm and the feed that I see, that it seems to be so vastly skewed sometimes to property. And I really wanted to cover that off as well
Yeah.
to, how, and this is that debt point that you've brought up, Amy, the amount of debt that people are taking on and hurting their cash flow, on trying to get to financial independence. And so sometimes people aren't covering off in some of the simpler and lower risk ways of doing that.
Yeah, people definitely this day and age prioritizing having investment properties, and you always hear there's the goal of having 10 investment properties by 40 years old or something like that, and it means going into a significant amount of risk and debt to
Yep.
leverage that ability to do that. And yeah,
Yeah.
the trade-off is, people do that to save tax as well as hopefully, think that that property is always going to go up and up and up.
Mm.
But yeah, the
And
trade-off being that easy win that we have to
mm,
reduce debt, reduce
absolutely.
tax in a different
Yeah.
way. Yeah.
And I think it's just, I suppose, a bit of the background why we're sort of keen to cover this one off. For me, there's two main reasons. Well, it could be three possibly. One, I know the right asset class to invest to get the best result over a long period of time, and that's
Yeah.
owning businesses, and that's owning businesses via the share market. The second reason, my algorithm, when I see the property spruikers, the ads, and the amount of people that are pushing property down people's necks, um, I can just see it's so conflicted and there's so many biases there, and ultimately they've only got one goal, and that is to sell someone a property where they get paid their 20 or 30 grand commission for selling that property. And it's all about tax, it's all about depreciation, it's not about the underlying quality of the investment itself.
Yeah.
And so there's that side of it where it's a much bigger story than just tax. And yes, people have done well over the last 20 years, and we'll cover off on some of the reasons why I believe that property prices have gone up in Australia.
Mm.
But that of course doesn't mean it will continue to do that.
Yeah.
And as we've been chatting to people all over Australia in the last 12 months, and after interest rates have gone up, we're seeing the downside to you know, you know these balance sheets that might look impressive on the asset side, but are incredibly unimpressive on the debt side. And although there's a nice big gap between the two, that the cash flow for these people has been smashed.
Yeah, that's right. The asset sheet is one thing, and that a balance sheet for people is, you know, quite impressive, and they believe even though there is that debt that it's covered by that asset. So at the end of the day, all is well. But it is that cash flow analysis when you get into that that causes the stress, and that's when people say, well, yes, this is why now I am coming to a financial advisor for another option. It's
Yeah,
that cash flow aspect for sure.
absolutely, and it doesn't matter what part of the cycle that we're in terms of, we've just had 2 decades of very extreme growth. Obviously, first home buyers know the pain in this country more than anyone, and it doesn't stop the property spruikers, the conflicted people, constantly trying to shove this down people's throats. And I think, when they've only got one hammer or one strategy, one product to sell you, I think this is where I was keen to have this chat, because with this strategy, it just comes with debt. Um,
Mm.
but before we kick off in real depth, Amos, acknowledgement to land, please.
On behalf of the Investor Motivation podcast, we would like to pay our respects to the traditional owners of the land on which we do record this podcast and pay our respects to the elders past, present, and emerging.
Cool. So, Amy, probably I think a good place to start is to acknowledge that over the last 2 decades, people actually have made money by
Absolutely.
investing into property.
Yeah, people have made money, and that's the biggest, I guess, what they people come to us saying, people do already know that we are quite property adverse based on what we have already put out on YouTube and the podcast and the like. So they do come to us straight away saying, we know you don't like it, but we have done well. And people have done well. They've gone into a significant amount of debt to increase their asset base. And of course, there's always that confirmation bias that any investor has that they've picked the right thing and they'll find anything to prove that point. And that likely is growth in the asset class.
Yeah, and I'm very pleased for the people that have taken on significant risk to do that, that they actually have been rewarded. So I
Yeah,
think that's,
absolutely.
that is fantastic. And as you said, a lot of the people that we've had coming in, they probably know that we have our strong convictions in terms of where we invest and why. But I'm just very pleased for them that they have had some upside, to reward the risk that they have taken on. And you know, doing nothing, would have been a worse outcome than what they've done. But I think with the cash flow, and now that it's been hammered by higher interest rates, they just know it's not going to work for them longer term.
Yeah, and not only the cash flow aspect of them having that financial stress now because debt levels are a little bit more unachievable due to higher interest rates, but it's also the priorities changing throughout life as you do approach retirement. You no longer want to keep up with the maintenance of the properties, pay the agent fees, have all of this kind of mental load going into retirement. People just want to simplify their balance sheets, and that's, yeah, completely
Yeah,
understandable too.
yeah. So I think it's worth going through and say, acknowledging that people have done okay out of property. They're not comparing to any other asset classes, and we can touch on that later on. But I think if we have a look at what's been some of the drivers over the last, let's call it 24 years, where property has gone up significantly, and I can go all the way back to when the Goods and Services Tax (GST) was introduced back in 2000, and I started in the industry in '98. So I saw this huge run where people were desperately trying to build properties and do stuff, up until 2000, 1st of June 2000, or sorry, 1st of July, sorry, feverishly trying to build these properties and do stuff and get it done before they had to pay the extra 10%. And what the government was scared about was there was going to be, after it was introduced, in the 2021 financial year, there was just going to be this big slump, that all the build was brought forward and now no one's going to build and the economy would just slow. So they introduced a first home buyers grants. And what that did was it, encouraged first home buyers, to get into the market. So, it's not a new thing where the government has tried to help first home buyers grants. But what generally happens if the government's handing out free money, it's inflationary. It
Yeah.
pushes pushes prices up of the assets that they're trying to stimulate. So that was probably one of the first ones. Amy, can you guess what the next one was in line in
Um,
terms of?
well, similarly, I guess that is another way of the government giving easy money, and lower interest rates also means easier access to money. So we have historically had those, 2-3% interest rates on home mortgages, which is very low and great, but that does also, make house prices inflationary as well, because we're a funny race. We take the utmost benefit to what's available to us. So the more money we have access to, we will take that and take on that extra debt and risk, and that is very, very inflationary to the
Yeah,
housing price as well.
absolutely. And we've got to go back quite a few decades to hear the stories from our grandparents or parents where they would say, well, when we went to the bank when we were young, we had to go in, we had to put the suit, had to put the tie on, we had to dress up to go and talk to the bank manager and nearly plead your case to please give us a loan.
A
These
loan at
days,
probably 17 or 18% too.
yeah. Now, these days, that the mortgage broker or the bank will chase you down the street and offer you as much as they can possibly give you within the law.
Yeah,
So,
absolutely.
so obviously, the low interest rates that we saw during, really post the GFC, the global financial
Mm,
crisis, all the way through into COVID, and obviously that's where there was emergency low interest rates. So that was it's cheap and easy money was a massive driver. One of the other drivers, and I think we've really got two more, obviously one was the global financial crisis.
mhm.
So nearly the whole system collapsed based on the property speculation, particularly, well, globally, there was a huge amount of property speculation and it was all driven by debt. And this is where the Americans would have all these very low quality loans. I think they called them ninja loans. It was, no income, no assets. So people were given loans that had no income and no assets to go and buy property. And then these loans were bundled up into these really complex investment products and sold globally to councils and governments. And obviously, it was something that had to unravel, and
Yeah,
unravel it did. And this is where you had Lehman Brothers. You had these huge catastrophes that nearly brought the whole system down. And
yeah,
and in Australia, what did we get during that time? Well, we had first home buyers grants, then we got first home builders grants. Interest rates came down to stimulate the economy.
mm,
We were exceedingly lucky because what China did during then was that they stimulated their economy by big infrastructure builds, which meant they bought a lot of coking coal to process the steel that they would buy the iron ore off us to make the
yeah,
steel for their massive infrastructure build. And what was that? That again was just really inflationary for our property and asset prices globally.
yeah,
But what we saw in the rest of the world, they were copying 20 to 40% price declines in their houses. In America, people could just walk back into the bank and say, "Here are the keys. I'm not responsible for this loan anymore." Australians
mm.
can't do that.
No, not at all.
So, and then the last one, COVID. What happened during COVID?
During COVID, interest rates went up.
Or yeah, it
Oh,
was
actually, the beginning of COVID,
yeah,
very beginning, was still all-time lows from the GFC. We had that, and
yeah.
people were, I guess, worried about the economy. So buying into property, because that's, bricks and mortar, people can
Mm.
trust that. And
Well,
interest rates were dangerously low and easy money again.
yeah, at a time when when people were losing jobs and they're you know losing income, this is where property prices should have come down. But the Australian government came in again with money to hand out, and I think there was it a $25,000 renovation or building grant
Yeah,
that
that's
was
right.
available. Emergency low interest rates, and obviously it's only been in the last because of inflation as the world had all these supply constraints and wanted to keep the wheels turning so economies didn't collapse.
Yeah,
Again, government stimulus, and it was inflationary, and property prices went up in Australia when they
it
should
should
have
have.
at some stage probably gone down.
Yeah,
So this is all the all the 2.5 decades of stimulus, low interest rates. to think that, and this is my point where the property spruikers, we have had some great growth in the past and people have done well, but to think it's just a never-ending cycle of up, to a point where people online are saying, you only need to pay the interest rates, you need to chase deductions, you need to be negatively geared, which means you lose money, because the growth will just continue to go upward and onwards forever,
Yeah.
is wrong. It can't just go, in one direction forever. And I think what we're seeing now is the limits of debt, where people are so indebted in our country that that's got to be the tipping point where people just can't handle the loans they've got.
Yeah.
So so that's obviously what's I think what's pushed things up over the time, and for me, it's the way that people are not, I suppose, thinking about their debt levels and not weighing the risk, and not probably let's say people have taken on debt in the past and the values of their properties have gone up. Well done, that's great. Your balance sheet has improved, but for people that are trying to that have been sold right now, the risk is greater than ever before.
Yeah, absolutely. And I think we've talked about it before, not that anybody has the crystal ball, even though property spookers probably tell you they do and that it will only go up. But we're also not saying that we're expecting property markets to crash, because as we've mentioned, there are a lot of entities behind the scene that have a hand in a game, really, and there's nobody that's going to tell you not to go into more debt, because property prices will continue to go up, or they will you know marginally go up over time. But there really is nobody out there that will tell you no. The banks will always be wanting you to take the maximum they can. We know that there's government, what's that register called online that you can always say the word of right that I can't?
Yeah, yeah. Now you got me on the pecuniary interest. So this is where,
Register of pecuniary
yeah,
interest. Yeah.
politicians need to disclose their interests in their investments, and a lot of these guys and ladies have got negatively geared property within that, and of course Australians' wealth is so tied to property.
Absolutely.
This is where the votes lie. So, is the government, they conflicted? I would say they absolutely are, and that's from they own a lot of this stuff themselves. So, do they want their assets to go down? Do they want their voters' assets to go down? Of course, they don't. They want their communities to prosper, because that means votes. They also want stamp duty. We're in Victoria. Stamp duty is huge. People
Yeah.
don't weigh stamp duty enough.
Yeah,
You know,
and there's no doubt that housing and the building of housing as well stimulates the economy a bucket load. So there's no way they're going to, make it less appealing to go into property or build property.
mm,
So yeah, we're definitely not saying that the property markets won't, rise in the future from here at all. We're probably just a little bit skeptical that it will continue as easily as it has when people's debt levels are as high as they are now.
correct. Quite right. I've been predicting a crash for 24 years, which means I've been wrong for 24 years.
That's right.
That doesn't mean that I've personally missed out on amazing gains, because I know where to invest. I've invested into businesses, some of the world's best businesses, and in terms of percentage returns, there is no comparison. Um, but it's I don't think there will be. There should be a correction of some type. 10 to 30% down. But will the Australian government allow that to happen? Well, they haven't in the past.
Yeah.
So will it happen in the future? Who knows? Um, so I think what we need to consider is that when people are looking at properties or being sold properties, I think people should be thinking about the people that they're dealing with and what biases and conflicts of interest these people might have.
Yeah.
So what I see is that the big discussion point around property is, it's around the tax outcomes. It's around tax deductions. So back to your point, who's going to tell you no? If you go to your accountant, Amy, and you say, look, I'm thinking about an investment property, and I think that I'll probably lose money on it each year, but we'll call that negatively gearing because that sounds just a little bit better. What do you think, Mr. Accountant?
Yeah, absolutely. It's a tax deduction. That's a job for me to do for you at the end of the day. Yeah,
Yeah, I,
definitely keeping accountants. Well, of course, they're always going to have a job anyway, but it just gives them more to do for you,
yeah,
which is definitely their job. So they're never going to say, no, don't do that. It's, yeah,
yeah.
bad for any reason.
Yeah, but Amy, you've done an accounting degree. A big part of, tell me if I'm wrong, but it was a big part of your tuition to get your accounting degree was learning about deductibility and
Absolutely.
depreciation.
Absolutely. And that's what I mean. It's the accountant's job to say, yes, that's a great way to save, or you can save a lot of tax in that way because you can. It is a way to save tax. But at the end of the day, it is always spending a dollar to save 30 cents. But it's not the accountant's job to tell you that there are better options elsewhere to do that as
Yeah,
well.
and I
Their
think
job is
that's
purely chase those deductions, and that's what they'll do for you.
yeah. So let's quickly chat about is negative gearing a good thing? So negative gearing essentially means that the income that's coming in from the investments is less than the cost to own the asset. So that means that you're losing money. And this is where people are getting to strife now, where their cash flow has been smashed, and that reduction in cash flow means that they can't do the lower risk options of simply concessional contributions into super or so on. So it's affecting their ability to save tax in other ways. It's affecting their lifestyle and also stress.
Yeah,
Um, but
absolutely.
so I think in recent times, obviously we worked on that Excel spreadsheet, Amy, where we could plug in some of the numbers for a client to say, okay, you've got 700 grand worth of debt. Here is the income coming in. Here is the expenses, and so on. And one that we did recently was it was around $700,000 worth of debt. And
Mhm.
obviously, I don't have the numbers in front of me, but I do broadly remember that it was, I suppose, they were losing money of about $31,000.
Yep. Negatively geared by 31,000, which meant that $31,000 needed to come from income, salary for that person.
Yep. And so, and this was that loss based on their average tax rate was, saving them about $12,500. So it was
Yeah.
around, you know, they've spent 31 grand to save $12,000.
Yeah.
So if you're 20 grand short, and obviously you've got to find this cash,
Mm.
that the property has to go up by that that 20 grand and some
Yep.
just
And
to be
grow
in
from there.
front.
Yep.
And this is the risk that I think where the property spruikers I've seen that the whole discussion is, oh, the government won't be there, there won't be a pension, you've got to look after yourself, there's all these scare tactics, and then
Mm.
it's all about the cash flow, it's all about the tax, it's all about the depreciation, where it should be more about the quality of the investment. And are you actually in the right asset class?
Yep. Absolutely. And I think we have touched on this maybe in a previous podcast, but that, as you said, that restriction of cash flow because you are using your employment income to then pay for this negatively geared property just to stay afloat in that area
Yeah,
restricts your ability to take those easy wins of extra salary sacrifice into super, which is, $1 going into super to save personal tax rates, but is then invested into wherever you want. It can be conservative cash if that's,
yes,
where you want to play. But it's the difference of putting that $1 into super to be invested how you choose versus $1 being put on interest, which is purely an expense, to then just save that 30 cents.
yeah. And probably with some of the chats we've had with property investors, that some people have done okay out of it. They've got capital growth, thankfully, but I can see that there's great pride in understanding the cash flow. Money out, expenses, what's deductible, the depreciation. So they've got their head around all that. But the problem is, and I believe very strongly in that they're just playing in the wrong spot. It's the
Yeah.
wrong asset class.
It's it, it's that confirmation bias that you can understand this whole thing and there are so many parts to it that you can understand, so you must be doing a good thing, that they just skip the part of comparing that to other asset classes, it seems.
Yeah.
Just,
So,
yeah.
and just so people know, obviously, Amy and I have just been such negative Nellies, and it's mostly my fault. This is, you know, I suppose my mentor is Peter Thornhill. Peter in Sydney, and obviously we've covered him off. There's a whole podcast. Just I
Mm.
think we did that after we caught up with Peter in Melbourne for a day's worth of a reset and training on stuff that we already know. His book is Motivated Money, which we give to our clients that come into the office, and so essentially he's got the research that goes back to the late 70s that compare businesses, so the stock exchanges around the world, businesses to property to cash, and his catch cry is that people say, "Oh, I've done well," and we hear this when we turn to our clients. So we've done well because, but compared to what? You haven't compared it to anything, and this is where he's the All Industrials Index. So that's the Australian share market, the All Ords, excluding all of the resources. He
Yeah.
does invest in the resources. We've got the data on why. The numbers are just not as impressive as investing into CSL and the Australian banks and so on. So that's the alternative that we teach our clients.
Yeah.
And you can do some of this without the leverage, without the risk. You can put money into superannuation and save tax on a yearly basis without 500 grand worth of stress. And when I say
Yeah.
500 grand worth of stress, debt. Debt is risk. And when cash flow is tight, that is stressful.
Absolutely. And I think a lot of people will tell you, or not you, but will say that they have done so well because of their ability to leverage. But again, if you were to compare apples for apples, and if you went and did margin loans in the share market world, that's how a lot of wealth is also accumulated. So it's comparing those two on an apples for apples basis that people just aren't doing. So yes, they've done well compared to or compared to have done nothing and just having cash in the bank or fixed interest term deposits. Yes, they've done well, but compared to that next asset class up, yeah, as
Yeah,
you say, there's daylight between those indexes on the chart.
yeah, there is absolute daylight, and and that's those numbers that we show our clients, where it shows the All Industrials Index. That's looking at a very broad range of businesses. But if like what we have done since the GFC, where we're buying Google and Microsoft and CSL for clients, it is absolute daylight in terms of your returns, and even 1994. It was obviously a while ago. You weren't even born there, Amy, but that's when CSL floated. And CSL has been one of Australia's great success stories. And when if people double their money on property, 100% up, that is a great result, and it is. 200% up is a great result, and it is. But CSL from your float at 80 cents to now at $300, it's about 38,000%.
Yeah.
Plus dividends. Now, dividends aren't high, they're not impressive, and that's because they retain so much of their profit and reinvest. So, I suppose one of the key things that I was keen to do with this is for people to, you know, perhaps to question, if they're going through a process and they're talking to people about investment properties, just to question, what other options are these people providing?
Yeah.
What other alternatives are there that may include not investing into a property, not going into debt? Do they have any other options? And if they don't have any other alternatives for you, then perhaps they're conflicted. Perhaps they only have one hammer in the toolbox, and that hammer is to sell you a property so they get their commission. And you know, and if property is as good as what these people say it is, why are they selling it to you? Why don't they keep it all for themselves?
Yeah.
And yeah, why don't they retain it and say, well, why are they giving away the farm? That if this is that good, why are they selling it to you? And not saying that these people won't invest in property, but I teach clients how to invest into share markets, into businesses, how to cope with volatility, which is the bit that scares everyone. And my portfolio within my self-managed super fund, within my company, within my trust, it's full of businesses or building up cash ready to buy more businesses at an opportune time.
Yeah.
Yeah.
Absolutely.
So
I
I
think
think, yeah,
even
people just need to question the people they're dealing with if they're going down that process of buying investment property.
Yeah, and if anybody is hearing this, and it's all well and good to hear something, but sometimes people do need to just see some figures. The Vanguard Index chart has just been updated for 2024, and that will compare all the different asset classes. So definitely worthwhile checking that one out. It's got some Australian property there, and then the share markets as well as cash and term deposits. So it's a great
Yeah,
place to look.
go and look at go and look at that information. I think that's just vital because
Mm.
it has business, it has US businesses, so US share market,
Yep.
Australian, global, and so on, and cash and property and all everything is there. Go and have a look at the long term data,
Hmm.
um, and I think that should be the information that you need to make decisions. And this is where that one point that we can all become financially independent and very successful from a financial point of view by very boringly saving tax with you're using the superannuation system.
Yep.
And then when that money goes into your superannuation at 15% and not 30 or 40%, you then get to invest in the right asset class. And
Mm.
that can be businesses within that. So save your tax, then find the right asset class, and then very carefully and boringly over a long period of time, you will become financially independent.
Yeah.
Mm.
What a recipe.
What's that?
What a recipe.
Yeah, look, it's
And
boring,
it,
but it's a
yeah.
good plan, and it comes with different types of risks to owning property. The property risk, and I think about the behind our business work there. There's a few investment properties just behind us, and there was a
Yeah.
monster skip bin. I would say a monster one in the front, and the tenants just left, and they left a mess. They had to bring people in from 2 hours away from Ballarat to gut this place, then to
Yeah.
wash the walls. To it, it
There's
was an event.
yeah, there's definitely horror stories, and that is that, and is good that that is the downside of property because it means when people are approaching retirement and want to simplify, they do come into the doors because they're ready to assess the other options because it has gotten so hard. There's those horror stories out there of bad tenants, no tenants, all the maintenance that it includes. So
Yeah,
I'm actually glad that the property game does have that one downside because it is a driving factor for people to come in here and say, what other options are there for retirement?
yeah.
Surely there's something easier.
And just for balance, the horror story or the downside in share markets is, the
Yeah.
tech wreck of 2000, the
Mhm.
global financial crisis, COVID down, 37% for the Australian market from top to bottom.
Yeah.
Um, Bear markets where for 2 years it goes nowhere but drifting down, and people have to get used to watching their balances go down progressively over time. So that's the horror story there.
Mm.
But that's also the opportunity that the
Yeah.
market gives us, and I think that's where make as advisors we teach people how to navigate volatility, how to navigate the bear markets, the crashes and the corrections, and that's a huge part of the game that I've
Yep.
learned over my 26 years, Amy. That it's not just about finding the Microsoft and Visa and all these amazing businesses. It's because all the best businesses in the world in a crash will still go down by 30%. It's how we behave during those tough times, and making the right decisions at the toughest times is the most important part by far.
Yeah.
And that's
Couldn't
how
agree more.
that's how we guide people, and that's when people need financial advice, and a good financial advisor the most is when the shit hits the fan and people feel really emotionally and psychologically spent, because it's
Mm.
really hard to watch your wealth go down.
Yeah, absolutely. And you do need that person there to hold your hand, project the numbers out, and say, let's just hold steady. We've got so much time ahead of us still to ride out a correction
Yeah,
and yet make the right decisions when it most hurts.
yeah, fantastic. Well, that turned into a decent sized discussion, Amy, but
It
thank you
did.
very much for indulging me on the chat. I just want people to try to think more laterally, and there are other options than just forever buying into one asset class, because it just comes with one thing we haven't mentioned is low or no diversification.
Yeah, very
Yeah,
true.
I think buying two investment properties, one in one town, one in another town, is not really diversification. It's still the one asset class. Yeah. So I think that's in addition to the risk, you're not very diversified, or you're not
Yeah.
diversified at all. Very good. So Amos, how can people get more information from us?
Um, on YouTube, we are also under Investor Motivation, so you can go there. There's almost probably 700 videos now, Rob.
Yep, getting up to nearly 700 videos. We've been doing this a while, so there's lots of great educational material there for everyone.
Yep, and then otherwise on our website, Consortium Private Wealth, there's also Peter Thornhill's Understanding Asset Classes, which is an e-learning course that you can take on there. It's free. You don't have to subscribe, put email addresses in or anything. So go there. There, he'll compare property to share markets, to cash, to term deposits. So yeah, again, a great resource there. Otherwise, on TikTok and Instagram, Rob is Robert Gowdy Financial Advice, and I am The Wealth Diaries.
Yep. Rob Gowdy on TikTok and Instagram. Yeah, people are allowed to ask questions there and reach out to us if required. So, yeah, thank you for anyone listening. And if anyone's got any questions themselves, please, yeah, shoot a question through. If you want a topic covered, Amy and I are more than happy to do it.
Absolutely. Until next time, everybody.
Fantastic. Thanks, Amy. Thanks, everyone.
Bye.
Bye.